Good afternoon, ladies and gentlemen. I am Chico, and I'm the lucky lady in a group of, as you can see, 3 guys, Archangel, Distone, and Robert. And our performance analysis is of the popular choice, Telecom Networks Malawi, henceforth known as TNM. So here we go. That's just an outline of our presentation, so I'll not really get into all that. I think it's safe to say that each speaker will, well, introduce the heading. My part is to talk to do the introduction. Now, our report evaluates the performance of Telecom Networks Malawi, as said already, henceforth known as TNM, which is a provider of mobile telecommunications services in Malawi. And we're using their financial statements from 2019 and 2020. And the financial statements have been used to critically analyze the performance of the company. It should also be noted that caution has been taken in using these financial statements because usually financial statements are due to, they're prone to manipulation, as said by those authors. Now, we've also used benchmarking by comparing TNM's ratios with the industry leader, which is Airtel. And this is in absence of established Malawi industry averages. The performance analysis tools that we've used are racial, vertical, and horizontal analysis tools. And these were used to understand the company's proportion of each line in financial statements. Sorry, let me just say that again. To understand the company's proportion of each line in financial statements, we used vertical analysis. And even though Fritzson and Alvarez cautioned that the common challenge that horizontal analysis poses is that the aggregation of information in the financial statements might vary over time due to changes on the accounts, and Weinhardt, I'm just assuming that's the pronunciation, argues that horizontal analysis enables analysts to assess a company's performance through financial statements data over a period. Now, Harkels and Teremis criticize the use of ratios in that they create biased efficiency estimates. However, ratios help to interpret financial statements, and the choice of suitable ratios relies on the purpose of evaluation, as according to Kim et al., Nadar, and Wadwa. So now let me just give a brief shareholding structure of TNM. As all the other groups that talked about said, TNM is 100% Malawi owned, but it started as a joint venture between Telecom Malaysia Berhad and Malawi Post and Telecommunications Corporation in 1995. And Press Corporation owns the majority of the company, which is, I found interesting considering that I think the first group that talked of Sunbird Hotels also owns that. So it seems Press Corporation invests a lot in different companies. And ownership is seconded by Old Mutual Life Assurance, which owns 24% of it. And Kim and Yi argue that a combination of both foreign and domestic shareholding is real. However, Taran and Mironiak argue that there is no significant difference in whoever owns the company. So at this point, I would like to hand it over to Archangel. Thank you. Oh, it's distant, sorry.
Thank you very much. I'm going to take off with a presentation on the liquidity performance of TNM versus that of the industry leader. So first of all, I'll be talking of liquidity is how a company is able to convert its assets into cash in order to pay off the debts and any other financial obligations. So the liquidity ratios which are used to measure this liquidity is this current ratio, asset ratio, and cash ratio. So the major difference in these 3 ratios is how they use the current ratio is just current assets and the current liabilities, while asset ratio factors in the inventories, and the cash ratio is just simply the cash and cash equivalent. So overall, TNM's current ratio in 2020 indicates that the current ratio is current assets would only cover current liabilities of 0.16 times, which is an improvement from the previous year, the same as the asset test ratio. So overall, in terms of liquidity performance, TNM performs very well, even compared to the industry leader, which is Airtel. So moving on. onto the profitability analysis. Pandey argues that there are different understandings of profitability, but IHIAC advocates for categorization of these profits into different categories in order to understand how the company is performing. So overall, when it comes to the profitability ratios, we looked into the gross profit ratio, whereby in T&M there was a 1.6% growth compared to that of the previous year, and the industry leader also increased by 4.9%. And then T&M performed below the industry leader in all parameters, including the ROE, the profit margin, the gross profit, the net profit ratio. So there's a huge difference between the T&M and the industry leader on the ROE and net profit ratio. So overall, there's a big drop in the profit margin by T&M from 14.12% to 18.85% in 2020. So going on to the loan service ratios, so long-term liquidity measures help to evaluate a company's ability to meet interest and principal payment on long-term debt. So the other scholars further, they argue that there are three, either of the three can be, which is the total debt ratio, long-term debt ratio, and debt equity ratio. They can be used because they highly correlate. So overall, in terms of the T&M, the analysis of the loan service ratio of T&M, there was a lower total debt ratio in both 2019 and 2020, which indicate that T&M is better off on the long-term debt compared to that of the industry leader. So moving forward to the efficiency measurement, the interest cover ratio. So the interest cover measures how the company, the amount of profits which are readily available to cater for organizations' interest payable. So, the stakeholders, shareholders, investors, they're always at risk of not getting the borrowers. We mentioned you see below here, there's a 76.2 billion debt loan, which T&M is liable to pay off. So there's a 20% increase from that of the previous year. So going forward, you see that the ability of T&M to service its debt has reduced just simply because of this, the 76.2 billion liabilities, which are to be settled off in the years to come. So at the same time, there was a dramatic decrease in the operating profit in 2020 by 28% as compared to that of the previous financial year. So lastly, I'll be talking of the dividend yield ratio, which measures how much an investor will get on each and every share that they hold. So in 2020, we can see that the dividend yield ratio dropped by 14.8% as compared to that of 2019, which was around 5.7%. So the market share also dropped significantly from 26 kwacha in 2019 to 20.07 kwacha in 2020. While that of the industry leader had increased by a certain percentage to 27.98%. So, as you can see on the dividend yield ratio, that of the industry leader in 2019 is not a simply question marks, just simply because the industry leader went public onto the Malawi Stock Exchange in 2020, in February 2020, yes. So you can see there's a big difference in shareholders and investors would be very much concerned about. So going forward, I would ask my colleague to come and proceed.
Thank you, Distone. We also went further in analyzing the performance of T&M using the horizontal analysis. And here, what we see is that the revenue of T&M dropped by 6%. And when you look at the industry leader, in this case Airtel, actually they had increased by 19%. And then you also see that on the operating profit, there was also a decline in T&M, while the industry leader actually increased. And here what we see is that one of the factors that contributed to that was the overhead. If you look at the overhead cost, actually it was about 8%, and that came from the increase in depreciation. around 31.4 billion. And then these issues of financial performance, the challenge is that whenever the operating profit is actually declining, the lenders sometimes they are at risk of actually not being paid their interest. And then we also looked at the vertical analysis, and in the vertical analysis, actually, from our group, what we were interested at was to see how much is each line in the income statement contributing to the revenue. And as you know, as all of you know, that for the income statement, the vertical analysis is actually calculated based on the revenue as its main basic factor. And here what we see is that, so like you can see, the 100% there, it means it's because revenue versus revenue to give us 100%. But then most interesting is that you would see that we have some drop-down bars, which indicate that we had some negative parameters in terms of performance. And what we see there is that we talked about the administrative expense. You see it is actually really eating or eroding the performance of TNM. And in this case, what we think is that this is a challenge and one of the issues that TNM has to look at. So for the recommendations, I will invite my co-analyst, Robert, to come in and continue. Thank you.
Yes, thanks very much. Having analyzed the performance of TNM, both vertical and the horizontal analysis, we felt we would do injustice if we don't offer some critical recommendations for consideration by the management as they think of maybe 5 years from now, how do they want to position themselves against the industry leader. Maybe they can become the industry leader themselves if they consider these recommendations. So we thought one, that based on the analysis that we've done, the following recommendations will help the company to improve its performance. We're looking at they need to think of how they can drive customer growth. They have already lamented that maybe people are not talking much, they are not utilizing much of the airtime. So that is another issue that they need to think about. But firstly, they need to have that clientele growth. And secondly, improve the network quality. You agree with me that as we're using the network, sometimes it just goes off and you're surprised what has happened. And that's another area that they need to improve. And then incentivize existing customers to utilize more talk time. Very important. Otherwise, because of maybe the pricing issue, that's what is pushing people away from using the talk time and maybe perhaps begin to use the bundles. And also, they should think of offering attractive data bundles. You know, with the COVID, we saw that in the annual report of 2020, the CEO of TNM was saying there is a great opportunity out there because most of the people are now turning to using more bundles as one of the measures to contain the pandemic, the COVID-19 pandemic. So if they begin to offer attractive data bundles, I'm sure that can do wonders to TNM. And they should also ensure that TNM is strategic positioning and operations is aligned to enhance sales revenue, as well as maintain competitive advantage in the long run. They need to begin to think ahead to say, where do we want to be maybe in the next 3 years also. TNM needs to reduce its network operating costs and administrative expenses as one major contributor to the losses. We saw how high the administrative expenses are. At the same time, we're seeing there is something that we can call overcapitalization. They're investing much in the capital assets than what they can contain. And so, getting to the conclusion of the matter, both intra and Firm industrial analysis showed that TNM fared very well in some areas, but also they poorly did in some areas. So most of these profitability ratios that we performed, it indicates that TNM poorly performed in 2020 compared to 2019 as the industry leader. However, TNM can still bounce back, leaning on the massive technological investments made with 31.5 million in capital, which will set its business on a solid path as they look for becoming a world-class digital service as they expand their 4G network coverage across the country. This we got it from the TNM PLC annual report. TNM is a still profitable venture despite performing poorly in some areas. That's why we recommend that it has to revisit its data management system to reduce the data period offered to the customers. It is long. That's why it's experiencing more bad dates. So it has to quickly check what can be done better. Because it is also its obligations, when they fall due, they don't have cash to pay. So that can push TNM into liquidity problems. And finally, it should take advantage of customer loyalty and build on this to expand its base by introducing more incentives to captivate even the existing customers as well as the new customers. You know, there are customers who have been with TNM since inception. What are they doing as a company to keep them on board? So basically, I will get into this juncture. Let me invite questions or comments from the group. Thank you. Yes.
Thank you very much for the wonderful presentation. Can you go back on the slide for the recommendations? Yeah, the first important recommendation, you are saying TNM has to improve its network quality. At the same time, you are saying TNM has to reduce its network operating cost. Personally, I see that there is a bit of contradiction, because if TNM wants to improve its network quality, it has to invest more on the network operations. So how do you think, what solution are you going to offer them, or can you recommend to them in as far as the improvement of the network is concerned? That's the first question. In terms of this, the second recommendation, you are saying TNM should ensure its strategic position and operation is aligned to enhance sales revenue. So when I was personally reviewing the statements, I saw that its strategic position was not really very clear. So in that case, you've seen that the reduction of their revenue, it has been attributed more by the decline of maybe one or two revenue generating activities. So as a group, what solutions are you offering to them in as far as the strategic positioning issues are concerned?
At the network quality, it's not an issue of quantity. What we've seen this company doing is quantity, wanting to be everywhere without managing the existing network appropriately. So even though it can cover the entire country, but if their quality of the network is poor, they will continue to lose customers. Because all that we want is, if I want to make a call, I want that call to be very clear. Now, it seems they are not putting much effort into the quality issue, but the quantity. That's why we're talking about they are running a risk of overcapitalization. So they need to manage the assets that they have now, improve the quality network so that we can all appreciate. If we are making a call and that call is super, we are able to hear one another without any problems, hassles and the like, then we can love the network, we can love the service provider. And that will boost their revenues, because we will remain loyal to them, because we are able to get what we are looking for. And then they can begin to increase bit by bit as years come by.
Yes, I think I'll try to attempt the strategic positioning. Actually, what I've seen being in Malawi is that the Airtel has taken advantage of TNM's sleeping in terms of partnerships. I think you know how Airtel has strategically made partnerships with different companies, organizations, both international as well as local. And in this case, you know, as an organization, they can't do that without actually putting that into their strategic focus. And then the other thing that we have seen is the issue that Robert was talking about, the quality versus quantity. It also boils down to the issue of who are we, and what do we want our customers to know us of being. So to us, what we think is like, I think if in their strategic positioning, they also talk about the issue of the quality, I think it can work well with the organization. One thing that we have also noted is that already the chief executive officer for 10M has already started talking to different organizations about the different partnerships. Yeah.